Have you ever looked at a price tag, maybe on some new gadget or even just a service you paid for and thought, is that really the whole story? Like, is that the true cost? We often just see that number, don't we? And assume that's it. But underneath, there's this whole hidden world of calculations deciding what it actually costs a company to make that thing. Welcome to the deep dive. Today, we're peeling back the curtain a bit on how businesses really figure out their cost. We're diving into, costing. And we'll look at two main ways they do it. The traditional way, which, as we'll see, can be a bit simplistic, and then a more modern approach that's, frankly, much more insightful. Our mission for you today is simple. Understand why getting these numbers right isn't just bean counting. It's actually key to making smart decisions and maybe even finding some surprising savings. So the big question we're kind of wrestling with is, can a simple calculation actually end up misleading businesses, maybe into making bad choices? And how much more accurate can we really get?
It's a really fundamental question. Because, for a long time, the way businesses thought about costs was pretty straightforward. You had your variable costs, things like raw materials. They definitely change based on how much you make. More units, more material cost.
Right.
Simple.
Right.
And then you had fixed costs. Think factory rent, insurance, stuff that's generally assumed to stay the same, no matter if you make 1 unit or 1,000.
Okay. Seems logical enough.
Well, what's fascinating, and where it gets tricky, is how often that simple split is an oversimplification. Think about it. Those variable costs, sometimes they can actually increase per unit if you're producing flat out. Maybe you're paying overtime, or materials get scarce and pricier.
Ah, okay. Yeah.
And the fixed costs, they're usually only fixed within a certain range. If a company needs to seriously ramp up production, they might need more space, more machines. Those fixed costs suddenly step up.
So they're not quite as fixed as the name suggests.
Exactly. They can jump.
Okay, so let's talk about marginal cost then. That's just the cost of making one more unit, right? So it focuses mainly on those variable costs. It sounds really efficient just looking at that extra cost. But I get the feeling there's a catch. What's the big problem there?
There is a big catch. The trap is if you only look at the marginal cost, you can seriously understate the true cost for producing something. And that leads to problems. Like, imagine setting your price based just on that low marginal cost plus a markup.
Yeah.
You might not actually be covering all your bases, all your real expenses.
So you could be losing money without realizing it.
Potentially, yes, in the long run. And another thing, focusing only on marginal costs. It often means companies completely overlook savings they could make by managing those fixed costs better. You really need the full picture.
Right, because those fixed costs aren't truly fixed anyway, as you said. So I guess traditional accounting must have had some way of dealing with them. Even if it wasn't perfect, what did they usually do?
Yeah, the conventional method is something called absorption costing.
Absorption costing, okay.
Basically, it takes all those different fixed costs, the rent, the machine depreciation, salaries, whatever, and it just lumps them all together.
One big bucket.
Exactly, one big bucket. And then it calculates a single rate, an overhead absorption rate.
Yeah.
Usually based on something simple, like how many hours people worked or how many hours machines ran.
And the appeal is just simplicity.
Pretty much. It's relatively quick. It's easy to apply.
Okay, let's make this concrete. Our source has this example, right? A company making 2 products, Ordinary and Deluxe. Total fixed overheads are $224,000. Labor costs $12 an hour.
Okay.
An ordinary unit takes 5 labor hours. A deluxe unit takes 6 hours. And they plan to make 20,000 ordinary, but only 2,000 deluxe.
Right. So quite a difference in volume.
Yeah. So if you crunch the numbers for total labor hours needed, it comes out to 112,000 hours. Which means that overhead absorption rate, the OAR, is just $2 per hour. The $224,000 divided by 112,000 hours.
Simple division.
Right. So using this absorption method, an ordinary unit absorbs $10 of fixed overheads. That's 5 hours times $2. And a deluxe unit absorbs $12 6 hours times $2. It seems almost too neat. Very uniform allocation based purely on time.
It is neat. And, this traditional way, it works okay under certain conditions. Very specific ones.
Like what?
Well, situations where fixed costs are actually pretty small compared to materials and labor. Think maybe older low-tech manufacturing, where labor is the big cost. It also works better when most fixed costs just tick up steadily over time and when you're churning out long runs of identical products. No fiddly customization.
But hang on, that sounds dated. Low tech, long runs, no customization. That doesn't sound like a lot of modern manufacturing, does it?
Exactly my point.
What happens when factories are highly automated? Labor cost is tiny then, maybe even part of overheads itself.
Right.
And customization. Think about companies like Dell, where you basically design your own computer. That means short, really varied production runs.
Completely different world.
It feels like you're trying to measure something complex with a really blunt tool. You're, I don't know, weighing feathers with truck scales. You're missing the nuance.
That's a good analogy. And even with just our two simple products, Ordinary and Deluxe, the source points out something crucial. That Deluxe unit, even though it's low volume, it could consume resources which are not properly reflected by the time it takes to make those units.
Ah, so the time doesn't tell the whole story of resource use.
Precisely. The core issue is these modern ways of working mean the old method just might not be good enough. Businesses really need to know the causes of overheads. And they need to realize, like we said, that many fixed costs aren't truly fixed. You have to assign costs based on the resources products actually use, not just some, well, arbitrary time measure.
Okay, so this really sets the stage. If the old way isn't good enough, we need something better, something that gives a more accurate picture of what each unit truly costs to make. And that, I assume, leads us to activity-based costing, ABC.
That's exactly where it leads, ABC.
So what's the philosophy here? It sounds like it's about activities.
Yes, the core idea is that activities cause costs. Simple as that. So you identify the activities needed to make a product, figure out what each activity costs, and then assign those costs. That old way of just pretending fixed costs are purely time-based, it's just no longer good enough when you've got diverse products and flexible manufacturing.
Makes sense. So how does it actually work? Is there a process?
There is. It's a pretty logical four-step process, actually. First, you take your fixed overheads, but instead of lumping them, you split them into distinct activities. These are called cost pools.
Okay. Activity cost pools. Step 1. Then what?
Step 2. For each of those cost pools, you identify the cost driver. That's the thing that actually causes the cost in that pool to go up or down. The cost causer, as the source nicely puts it.
Find the driver. Got it. Step 3.
Step 3 is calculation. You figure out a cost per unit of that cost driver. So you take the total cost in the pool divided by the total amount of the driver, like cost per machine setup or cost per order processed.
Okay. Cost per driver unit. And the final step.
Step 4, allocate. You assign those costs back to each product based on how much of that cost driver the product actually uses. It's much more precise.
Right. Let's try applying that to our Ordinary and Deluxe example again. Same total overheads, $224,000, but now we split them.
Exactly. Let's break it down.
Okay. First activity. Batch setup costs. Total is $90,000. And
No.
the driver. The number of setups.
Makes sense. Setting up a production run costs money.
Right. So Ordinary needs 10 setups for its 20,000 units, but Deluxe, made in those small batches, needs 20 setups for only 2,000 units.
Big difference in setup frequency there.
Yeah. Total of 30 setups. Okay, next cost pool. Stores material handling. That's $92,000, and the driver is the number of components used.
Yeah.
Ordinary uses 20 components per unit, so 400,000 total. Deluxe uses 30 components, so 60,000 total. Grand total, 460,000 components handled.
Different complexity in materials too.
Definitely. And then there's the leftover other fixed overheads, $42,000. The source says we don't have a better driver identified here, so we stick with the old labor hour basis for this bit. That's still 112,000 hours total.
Sometimes you have to do that, use the best available driver, even if it's not perfect for every single cost.
Okay, so that's steps 1 and 2. Now step 3. Calculate the cost per driver unit. For batch setups, $90,000 divided by 30 setups. That's $3,000 per setup. Wow.
That's a significant cost per setup.
Yeah. For storage material handling, $92,000 divided by 460,000 components is 0.20 cents per component.
Okay.
And for the other overheads, $42,000 divided by 112,000 hours is 0.375 per labor hour.
Right, so now we have our rates per activity driver.
Now for the allocation step 4, this is where it gets interesting, I bet. Let's look at batch setups first. Ordinary units are made in big batches of 2,000. So that $3,000 setup cost spread over 2,000 units is just $1.50 per unit.
Pretty small impact per unit because of the large batch size.
But Deluxe. Tiny batches of 100 units. That same $3,000 setup cost spread over only 100 units. That's $30 per unit.
$30 just from the setup cost. That's huge compared to the $1.50 for Ordinary.
Massive difference. Okay, storage handling. Ordinary gets $4 per unit, 20 components x $6 per unit, 30 components x at x 6.20 cents.
So Deluxe is a bit more costly there too, reflecting the extra components.
And finally, the other overheads based on labor. Ordinary gets 1.875, 5 hours x $0, $375. Deluxe gets $2.25. 6 hours x $0, $375.
Okay. So when you add all that up, the difference between ordinary and deluxe under ABC must be way bigger than the $2 difference we saw with the old method, $10 versus $12.
Oh, absolutely. The ABC approach substantially increases the cost of making a deluxe unit. It's not just slightly more expensive, it's significantly more expensive.
And the main reason is clearly those batch setups.
Right.
Primarily, yes. Because deluxe is made in those small batches. Each batch triggers that expensive $3,000 setup, but the cost gets spread over far fewer units. And really that's only right, isn't it? That the extra effort and cost needed for small batches gets reflected properly in the unit cost.
It makes intuitive sense.
And it has big implications.
Yeah.
If your selling price for deluxe doesn't actually cover this much higher cost revealed by ABC, well, the source says there might be little point in producing deluxe units at all.
Wow. So ABC isn't just about getting the numbers right for the accountants. It's giving you information that could fundamentally change your product strategy.
Exactly. It's strategic information.
And I guess it also points towards where you could save money, because you can see exactly where the costs are coming from.
Precisely. ABC provides a better indication of where cost savings can be made. Look at Deluxe again. We saw that batch setups are a huge chunk of its cost. The source says almost 25% of the total cost per Deluxe unit.
Okay, so that's a massive target for improvement.
Right. And this feeds directly into what we call performance management, actively using this kind of insight to improve how the business runs.
So you don't just calculate the cost, you ask why it's so high and what you can do about it.
Exactly. So the obvious question becomes, is there any real reason why Deluxe has to be made in batches of only 100?
Could they make bigger batches?
Maybe. If they could increase the batch size to, say, 200 units, that would immediately cut that $30 per unit setup cost in half. It would dramatically reduce those setup costs.
That's a direct, actionable saving identified purely because ABC showed you where the cost was concentrated.
That's the power of it. Now look, the traditional absorption costing method is simpler, no denying that.
Sure, less work involved.
But, as the source argues, simplicity does not justify the production and use of information that might be wrong or misleading.
You might be making decisions based on faulty data.
Correct. ABC definitely requires an organization to spend time and effort investigating more fully what causes it to incur costs.
Right.
You have to dig deeper. But honestly, understanding the drivers of costs must be an essential part of good performance management. Investing in that understanding usually pays off.
So it really feels like we've journeyed from a kind of broad brush, maybe even misleading view of costs to something much sharper, much more useful. Thinking in terms of activities changes the game.
It moves you from assumptions to actual insights, actionable insights.
Okay, so here's a final thought for you listening in. If even a product cost can be so much more complex than it first appears, what about in your own life? Or your work? Are there fixed costs, maybe habits, routines, subscriptions, processes that you just take for granted? What are the real activities driving those costs? And if you understood them better, like with ABC, could changing those activities unlock some surprising value or efficiency? Something to maybe ponder